The federal interest rate, often referred to as the federal funds rate, is the interest rate at which banks lend money to each other overnight. This rate is set by the Federal Reserve, the central bank of the United States, and serves as a key tool for managing the economy. It influences everything from loan rates to savings account returns, making it one of the most important factors in the financial world. Why is the federal interest rate important? The federal interest rate affects the cost of borrowing and the incentive to save. It's a cornerstone of monetary policy, helping the Federal Reserve achieve its goals of controlling inflation, stimulating economic growth, and maintaining employment levels. Here's how it works. When the Fed raises the rate, borrowing becomes more expensive, discouraging spending and investment, which can help reduce inflation. When the Fed lowers the rate, borrowing becomes cheaper, encouraging spending and investment, which can stimulate the economy during slowdowns. How does it affect you? The federal interest rate doesn't just impact banks. It affects individuals and businesses too. Loans and mortgages. When the rate goes up, borrowing becomes more expensive. This means higher interest rates on loans, credit cards, and mortgages. Savings accounts and investments. A higher rate can lead to better returns on savings accounts and fixed-income investments like bonds. The stock market. Lower rates can make stocks more attractive by reducing borrowing costs for businesses, while higher rates may lead to slower growth and falling stock prices. Example of federal interest rate impact. Let's say you're considering a $300,000 mortgage. If the federal interest rate is low, your lender might offer a 3% interest rate, resulting in lower monthly payments. If the rate rises, your mortgage interest rate might increase to 5%, leading to significantly higher payments. This difference can have a big impact on your budget over time. How does the Fed decide on interest rates? The Federal Reserve sets the federal interest rate based on economic conditions. It considers factors like inflation. If prices are rising too quickly, the Fed may raise rates to cool the economy. Employment. If job growth slows, the Fed may lower rates to encourage spending and hiring. Economic growth. To support sustainable growth, the Fed adjusts rates to maintain a balance between too much and too little activity. Benefits of a controlled federal interest rate. Economic stability. Adjusting the rate helps control inflation and avoid economic bubbles or recessions. Accessible credit. Lower rates encourage borrowing and investment during economic slowdowns. Savings incentives. Higher rates reward savers and attract investments in low-risk assets like bonds. Drawbacks of rate changes. Higher costs for borrowers. Increased rates can make loans and mortgages more expensive, impacting consumers and businesses. Understanding the federal interest rate is crucial because it influences everything from personal finances to the broader economy. It's the Fed's primary tool for keeping the economy balanced and moving in the right direction.